So I had a chance to bring my buddy Kevin Green on this morning, and I was excited to do that. Always pumped to have these conversations with Kevin, especially with so much has been going on. We haven't been able to talk for a little while, and I really want to get his opinions on what we're thinking of the market right now. So many things happening. You guys have heard me talking about the Fed lately, the crazy move in gold that's just kind of continued, possibly energy joining the party, copper miners looking great, copper not looking as great. You guys have heard me talk about all these things, but I really want to get to Kevin, hear his opinions on these subjects since we haven't heard him in a while. For those of you guys who don't know, if you guys check to my YouTube channel, The Commodity Report, there's a playlist. You can see all of our videos. We've been putting out videos for a long time, so definitely check those out. So first off, Kevin, how are you? Good to see you, man.
Good to see you too, man. I'm glad to be back on. And yeah, it's been a little crazy, a little hectic. I took like a month off from work, which was great. And getting back has been pretty busy, but a lot going on in the markets. And I just appreciate you having me on. I watch all the videos. I watched you with Kashop yesterday, right? Like you guys were kind of breaking down the UK bond thing. And it's you guys always provide really great content. So happy to be here and ready to talk about whatever. And if people have any questions, by all means, they can submit those as well. We can kind of hit those topics. So I'll let you lead with it, and I'll follow.
Yeah, definitely drop some questions because I don't know if we have all the answers, but we'll do our best to answer it any way we can. We've been navigating these markets for a long time. So, first off, I want to start out with gold. You brought this chart of gold. And I know so many traders out there, they're either, people have very strong opinions about gold one way or another. It's either gold's the best thing in the world, it's going to change your life, put all your money in gold, or it's I hate gold. I lost money in it in 2012. And it's kind of been in this hated rally for a long time at the moment. Not hated by, speculators and so on. We're kind of seeing them get a little too long at the moment. But looking at it, just from a sentiment perspective from the retail crowd and other traders. And we had this consolidation up here, finally breaking out a little bit higher. What are you seeing in the precious metal space? Do you think this thing still has legs, or do you think this thing's coming to an end sometime soon?
Jason, this technically speaking, yes, we had a consolidation. We continue to break higher. I always look at weekly charts. I think those give you a little bit of a better guide, especially when you're talking about the commodity space. And so from a technical standpoint, we did see a consolidation for since like May or so. And what was actually very interesting about this breakout move, we actually saw this area of resistance that we touched literally 6 times in this whole consolidation back in, let's say, end of April or so. And that was around that 3490-ish area where we continued to hit it, but we weren't able to break out. But we were still making higher lows. And so obviously the dynamics when you're looking at gold, the technical structure, that 20 period moving average on the weekly continues to be a firm area of support. And now we have seen that breakout. When you're kind of looking at, like, why do you trade gold? Why do people trade gold? Some people think it's an inflationary hedge. It's a dollar risk hedge as well. And we definitely see that when it comes to the central banks. You also have the speculators that are kind of getting into this. And I think that's probably where we are at within this cycle, is more speculators kind of pushing prices higher. But if you look at the dynamic and the fundamentals for gold right now, you have a situation where the economic situation here in the United States, as well as around the world, is murky at best. I think we could say there's some bright spots when it comes to some economic data, and there's definitely some weak spots. You have what's going on in the UK just in general. That seems like that's a powder keg that's waiting for something to happen. And I think in November, when they release that budget, is probably when we'll see peak vol there. And then you have a situation where central banks, especially China, continues to build up their gold reserves, and let's say, I don't want to say selling off their treasuries so much, but not backfilling their treasuries as aggressively. And you can also see that type of reaction to this fundamental landscape within the T-bill auctions. No one talks about T-bill auctions here in the United States, right? But they actually have been very weak. They're getting weaker over the last 3 months or so. And I think that's actually a sign. So even though yields on the front end are going down because the anticipation of rate cuts, you're seeing actual dealer takedown rates actually increasing a bit. And so the foreign demand is starting to kind of maybe slow down a little bit. And all of that gives the environment for gold to kind of move higher. You're going to have a rate cutting regime. We see maybe some politics going into the Federal Reserve. They might be trying to run this economy hot, looking at aggressive rate cutting policy from the White House that that wants to translate over to the Federal Reserve. And I feel like when you're kind of looking at this, it's kind of reminiscent of the early 90s, mid 90s situation where we had rate cuts, aggressive rate cut policy that we might see next year, which runs the economy hot. And what's the difficulty that we actually have right now is the labor market. And you and I early on this year talked about the labor market. I wrote about this whole weakness that we might see. And I was looking at more Q2 into Q2. And you could kind of say that actually did happen, right? Because in June, we did see the final revision, negative jobs being printed for the month of June. You have a situation where labor market is starting to weaken a bit. You have inflation that continues to be, let's say, sticky at best. You have tariff policy that's just starting to kick off. And I want to go through this whole rant, but people were saying, hey, look, we have tariffs, but we're not seeing it reflected in the inflation data. But 80% of those tariffs were not really fully in effect. They just started going into effect. So now we'll see the impact of that. And now everybody's saying, okay, well, it's going to be short-lived. It's going to be transitory. And then that's kind of coming into effect. So given that environment, gold usually thrives there until a point, until something actually breaks. I get a little concerned when gold and equity markets rally in the same fashion. And you can kind of see that even on the intraday basis. Equity markets pull back, gold pulls back aggressively, then it kind of catches a little bit of a bid. So that's something to be mindful of. But gold right now, technically speaking, seems like it's still in an uptrend. And if the environment like we have right now of uncertainty continues and remains, I think that's probably going to be a tailwind for gold, at least for now. And then you're looking from a technical standpoint, a breakdown below that 20-week moving average is your first signal that we might see a reversal. So I kind of went over a lot there. Just remind me about silver, because I want to kick it back to you and kind of get your thoughts. But silver is going to be a little bit different, and that one's actually a very interesting one.
Yep, silver's up next. But no, I love the way you're thinking here, because that's the same thing I'm kind of looking at here. We've had sticky inflation. I mean, you said at best, like sticky inflation is the one thing I think nobody can debate. Like whether you go out, if you're a normal person, now you could debate it if you're looking at just the data or something, saying it came off a little bit or whatever. But if you're a normal person, you go to the grocery store, you go buy a 8-ounce grass-fed steak for $12. I mean, it's getting a little ridiculous. Not to mention, just grocery prices haven't come down. Just going, out to eat hasn't come down at all. We continue to have this very sticky inflation situation. The one thing that Powell did very well, which is just sit on his hands. We don't see that much from Fed chairs. We don't see them just kind of go, hey, we're going to leave it like this. We think that inflation is going to come back, and that's the big risk. Until finally, there's been so much political pressure put on the guy that now we're in the situation of, hey, we might. People are talking about taking over the Fed. I don't know if that's going to happen, but it's been in talks, and it could happen. Yeah. So, like you've said this before, which is what Donald Trump says, take him seriously, and I believe that. I think you're very right on that point. And so, if we go back to the next part, which is okay, well, sticky inflation, then they're going to talk about getting rid of or they fired one of the Fed chairs. It's just a situation that people lose faith in their monetary policy in those type of situations. And I think money is going to continue to flow into these areas like gold, just as this kind of safe haven, something that, might work. Like, let's say, interest rates come down, gold would work fine. Let's say inflation stays sticky. I don't know or inflation goes up a lot. If inflation goes up a lot, gold, it's not its favorite environment for gold, like the physical metal. Maybe the miners will do really well, but the physical metal. But at the same time, it's going to go down a lot less than everything else. So I think we're looking at this scenario here where gold can do well in most of the environments that are upcoming. But I also am with you on the fact that gold is moving with stocks right now, which is most of the time is a late cycle environment type of thing where we start to see these type of crashes, big pullbacks. That can happen. So, once again, I'm not saying I'm going to sell all my gold and run for the hills or anything. I'm just saying continue to stay long here. But there are risks out there. And so we'll get to silver next. I know you had more on that, and I do too. So excited to hear your thoughts on this because, the silver's finally starting to move. We're starting to see this thing making some new highs for once in a very long time. What do you think about silver?
Look, I mean, silver has been moving. What's actually very interesting about the silver markets, no one loves it until it actually starts to actually break out. But if you look
Yeah.
at the performance on a year-to-date basis, I think silver, depending on how you measure it, which futures contract you're looking at, silver has already outperformed gold. It's a higher
Would it?
beta play on the
Yep.
inflationary front,
Mhm.
right? Now, if you're looking at it from a chart to chart standpoint, has silver had the same run as gold? Just looking at the chart, it has not. But if you're looking at if you're looking at percent change, it's been doing a phenomenal job here. And now it is actually breaking out. So this is a 3-year weekly chart. You are seeing that longer term trend line where it has been an area of resistance now breaking out, potentially turning into an area of support. We had this bearish divergence that was also taking place pretty much back from May of 2024 until about June of this year. That bearish divergence has now kind of, let's say, resolved itself in a consolidation, and you have MACD still in a bullish formation here. So the silver market itself, similar to gold, right? Silver is a precious metal plus an industrial metal, and actually the industrial application is really what matters. If we are in an environment where we are going to run the economy hot, and you do see maybe an uptick in manufacturing growth, which we can kind of talk about how that's a little bit murky at best right now as well. Just given the fact that we are still seeing manufacturing jobs kind of we're losing them, and then we have all of these commitments for trade deals that I would say is probably questionable if they'll actually come to fruition. Some of it's just numbers itself. I mean, the EU deal sounds really great on paper. The feasibility of all of those dollars actually hitting the United States, especially given the energy capacity that we have, probably a little bit unlikely here. But if you do get this kind of structural relief, especially from China, in the consumer demand front and the electronics front, silver can actually do fairly well in that type of environment. It wants to see economic expansion. It also wants to see a little bit of inflation. And silver is one of these metals that is in a technical structural deficit if you add in the ETF holdings, right? And so there is a demand story that is there. Let me go back on the other side of that, though, as a silver, observer, if you will. I do not like the fact that it's broken away from its technical trends. Silver used to be one of those metals where as soon as you saw bearish divergence, you could short it, it would go down. And you would find an area of support, it would hold support, it would move back up, it would re-rate a little bit higher, and then kind of get back to the technicals where you're looking at RSI, MACD, CCI, whatever you really want to use. Silver's not doing that anymore. So you're kind of, if you're a traditional silver trader, let's say like the blinders are on a little bit more right now because there is a fundamental story that's being told. And I think there is a little bit of a catch-up trade. And it's probably a little bit easier to push on the retail front, silver to the upside, at least for now. And so silver, once again, we get an early 90s type of environment. Silver could be another one that continues to try to show some strength. And if you're going to get a signal that the metals are breaking down, silver is probably going to be the first one to truly kind of tell you or show you and reflect that maybe some of the risk that you have, the inflationary risk, if that kind of goes away, silver probably will be the one that kind of pulls back aggressively quickly first before kind of gold does. I added another chart to the last slide of the deck. If we can kind of talk about the inflationary front and kind of how it ties into the gold and silver play. Hopefully it was able to get in there. Is there another one in there for you?
No.
Slide 10. Okay.
I'll bring it down. I'll bring it back. I just probably have to refresh.
Okay. Yeah. Sorry about that. But it's kind of important here. So when you're kind of looking at the inflationary front, can we still see inflation kind of rise to the upside? There's going to be a 50-50. I think it's actually a little bit more 70-30, if you will, but that's just me. If you kind of look at the inflation picture right now, are we still seeing some sticky inflation? We are. Where is it coming from, though? And I think that's actually very interesting. You're not actually seeing inflation coming from the energy front. For the most part, that's been a deflationary measure. if you look at utility prices, we have seen some pressure there. And I think that's actually one of the bigger risks that you have for inflation next year. It kind of goes overlooked, if you will. I think that's around 6.5%, maybe 8% of the kind of the energy composite or component. But it's something that we feel on a day-by-day basis, or at least a month-over-month basis. And there's obviously the demand picture when you're looking at artificial intelligence and data centers. Yes, that's also fueling it higher. But you have a situation where utility prices are moving higher. Now, this is a chart that compares ISM services, PMI, right? Let me make sure I have the prices on there. I'm pretty sure, yeah, these are the prices. ISM services, PMI. Oh, this is just the PMI, but I'm sorry, I got to get the prices on there. PMI kind of tracks this. But basically what I want to be able to show is ISM services PMI prices have been moving to the upside. Prices paid index has been moving to the upside. I'm going to send an updated chart here. And what's actually very interesting, it's like a 3 to 6 month leading indicator when it comes to headline inflation when you're looking at CPI. And the inflation rate. And so we are kind of at the beginning stages of seeing, obviously, ISM services prices kind of moving to the upside, but we have not seen it actually truly reflecting to CPI. So I think that on the inflationary front, there's still an opportunity to see inflation move higher. Now, what is the risk there? Because I know that we're going to talk about stagflation. Stagflation, we got to make sure we understand this, is a weakening economy, right? Economic growth slowing, prices moving higher, labor market cooling. We right now only have 2 of the 3 components there. You still have GDP printing at around a 3%, let's say 2.5%, 3% clip if you're looking at these numbers here. And so until we actually see GDP kind of stall out, that's where you can say, hey, there's a stagflationary environment that's there. That is also another key driver that you could have for the precious metals like silver and gold. So I'm going to update this chart so we have the prices on there and you can kind of see that correlation. So there's a lot of tailwinds when you're looking at the metals complex over the next, and if this dynamic kind of does play out to how I'm thinking of it, I mean, there's a lot of tailwinds there. It's just, you got to be prepared for the aggressive re-ratings, and people usually are never prepared for that. I updated that deck again. So you want to kind of look at that. So that's kind of what I'm looking at. So I put it at the last slide so people can kind of get a look as to what I'm talking about here.
Yeah, give me 1 second.
So if you're in an inflationary environment, what you want to, hard assets generally perform decently well. So you're looking at metals for the most part. Copper obviously lost a little bit of steam. We can talk about that one here in a little bit, but I think this is it's a hard trade right now to fade the metal space until you see the technical breakdown or the narrative changes. Okay, so here's the chart that I wanted to bring out. So this is in blue, ISM services manufacturing prices, right? And this is services, non-services, non-manufacturing prices, or we just call it ISM services. You see the price in blue, and then you see in gray the inflation rate of the United States, the CPI. So it's actually a really decent leading indicator where we see
that's a huge divergence.
About 6. Yeah, so we have a massive divergence. Yes, exactly. And those divergences usually don't last for too long. And so there's the one thing that's going to happen. Either one's going to come down very aggressively or one's going to move up aggressively. Well, in the services space, as well as the manufacturing space, what are they seeing right now? Higher prices, just because of tariffs alone. So to say, hey, we're not actually seeing the effects of this, the purchasing managers are right now. It just hasn't been translated. We're holding on passing those costs off to the consumer as much as they possibly can. They might be waiting for maybe some court decisions to kind of fizzle out. They might be wanting to see how the consumer actually kind of handles this. Are they going to see a slowing in demand? That could be another thing. But we are not seeing right now, you're not seeing a compression in margins because of tariffs yet. And so what we see on the tariff front, what we should see, because anytime that you enter something new into a system, it has to translate itself somewhere. And it might show up in all different places. Just because we have a 50% tariffs on XYZ prices doesn't mean that the price for the consumer is going to go up immediately 50%. It could be a 25, type of split that takes place. But you're either going to see an uptick when it comes to the export cost, right? That could also be translated into shipping. You also look at the manufacturing prices and to be able to have margins in order to turn a product from an intermediate good into a final good. You might eat margins there, and then you may see higher prices on the for the consumer. Right now, just based on the earnings season we just had, you're not really seeing a compression in margins. And so this is still a wait and see moment. But I can tell you, as soon as you enter something into a system, and this is a closed system, our economy, if you look at the global economy, even though it doesn't seem like it's a closed system, it still is. As soon as you enter something new into that system, it will translate somewhere. And I think that there is still risk on the inflationary front for it to move higher. Is it going to go to 6%, 7%? No. I'm not a firm believer of that. It might, but I'm not a firm believer of that. But there still will be sticky inflation. And so if that's going to take place, you have to find assets that could outpace or at least match with that inflationary bump. And usually in these type of cycles, hard assets are able to do that.
Yeah, and I love this chart because this is this is a simple way to kind of, I keep looking to the right because the charts are over there, but they're over here too. But when we look at this, like it's a simple way to get an understanding of like what people are seeing as opposed to what the Fed is seeing and what other people who are looking at the inflation in the market are seeing. Because a lot of people keep telling me there is no inflation, Jason, you're crazy. Like, and I'm like, gold isn't like the best inflation hedge in the world. Like a lot of people look at gold and they go, that's the inflation hedge. Like you got to use it as an inflation hedge. It goes up in many environments. It's kind of similar. It's more similar. And this is funny because a lot of people are going to hate this. The technology actually moves in a way gold does a lot of the time. Now, not every time, not talking about the 90s, but sometimes in the last like 5 years, we've seen kind of a correlation between gold, and that can sometimes mean real rates are going lower. Gold loves lower real rates. What that is the inflation rate against the 30-year bond rate, or however you want to bond yield, or however you want to look at that. But there's a bunch of ways to look at that. But looking at it just in a way that now gold has kind of diverged from the bonds completely. Gold is just kind of moving, even though real yields are still staying the same. To me, that's kind of saying like, inflation is coming up. And the reason why I always say gold is telling us that inflation is coming up is that at first it's a monetary thing. People might lose faith in their government. People might lose faith in the dollar. People might lose faith in whatever it is. And then you'll see gold start to break out and start to move. And if it just moves for a little bit, that's something. But gold moved without any news and no real reason for the massive breakout to start happening. We get to 2,500, 3,000, 3,500, above 3,500 now. Now we're seeing silver join the party. And like Kevin said earlier, that's a good way of also looking at this trade. If silver started to move down, I would say this is something different. But this is really telling us that there's risk on in the precious metal space. When gold started moving sideways, this was my favorite thing about this whole rally in gold. Gold moves sideways, and then we see the miners just break out, over and over again, just moving higher every single day. Like it was wild, and everybody kept going, well, gold's dead. And the whole thing is silver's moving, the miners are moving. That's what you want to see in this type of a cycle. You don't want to see gold just continue in this massive uptrend over and over. You want to see it move into the other parts of the precious metal space, and more importantly, into other parts of the commodity space. So I think that's going to be the real catalyst to start seeing the gray line on this chart move up. Like you said, energy, utility, these are big weightings in there, but we haven't seen energy make a move yet. So let's get back to a couple other ones, because I know you brought some charts of copper. I know you brought a bunch of good stuff. So let me get this back to where we were, and we'll get back to that in like 5 seconds. But yeah, there's just so much going on. But we'll start with the dollar, Kevin. I want to know, I got you on here. I got to ask you the question, obviously, what's going on with the dollar, Fed rates? This is all important because we're always kind of looking at the macro picture here. So when we're looking at the dollar, the Fed, what are you thinking? Like some people are going, oh, the Fed is going to lower rates and it's going to do this. And some people have been actually telling me this one, Kevin. I'd love to ping this off of you because I'm tired of talking about it. But people keep coming to me and going, Jason, the Fed's lowering rates. Why do you think inflation is going to get out of control? That's going to be deflationary. Now, that to me is just the opposite of what I'm looking at. Maybe in the short term, it brings down the long end for a minute, but I think inflation is going to get out of control by anyone. Like, it's kind of a melt up scenario we're looking at, where we just see kind of everything moving higher, similar to end of 2021, and then probably getting into more of a stagflationary style environment at some point. But I'm just more asking you, what are you seeing out there with the Fed? What do you feel about them lowering rates? What do you think is going to happen to the dollar?
Yeah, there's a lot there. I'm going to try to be really look, the Fed is, if you're looking at monetary policy right now, I would say just focus on the next 3 months. Don't try to like extrapolate out what the Fed's going to do this time next year, because things definitely will change. And I think, once again, the stars are kind of aligning that we will see the Fed starting to cut aggressively. And maybe a lot of that may not be based on the actual hard data. Let's just say that. And that's kind of where I think the Fed is actually going to be going. So are we looking for a rate cut in September? Yes. 25, 50 basis points. 25 seems like it's comparable, in my opinion, rather than doing 50. Starting off with a 50 basis point cut is usually not a great sign. And then you start thinking, okay, October or December. I'm still of the mind that we still see 2 rate cuts this year, in September and then in December. I don't think we get an October cut. Is the labor data right now a little bit concerning? It is. Yes, you are seeing a little bit of a deceleration, but we have to be mindful. There is a structural shift that's happening in the labor market that we have actually probably never seen, and definitely in my lifetime. And we probably haven't seen it in a very long time, where you are seeing immigration having an impact when it comes to the labor market and labor supply. So we are seeing that tighten up a little bit. As far as the labor market, just in general, you can see it with JOLTS, where you have, now it's we have more people that are looking for work than we have job openings. I take JOLTS with a little bit of a grain of salt, because JOLTS has been very distorted since COVID-19. So if you kind of look at the trend is definitely going lower when you're looking at the job openings. But if you kind of look at the actual nominal level compared to where we were at pre-COVID, it's actually still relatively high. But I think the market right now is trying to figure out what's that new baseline for non-farm payrolls. In the past, it used to be, hey, if you do at least 75,000 jobs a month, you were okay. 100,000 jobs, you were doing good. But now we're starting to see 30,000 or 22,000 being added. And now people are a little bit concerned about that, and rightfully so, because it's a new type of environment. But what if this is actually the new norm? You take labor supply out of the picture, you start to tighten that supply up. And what if the new norm now is 35,000 jobs, 30,000 jobs being added a month could actually still sustain an unemployment rate of 4.3%? And that's where that's where the numbers really don't add up to what we've seen traditionally. And so I think we're in this digestion period of what is that new norm? And no one really knows. And so that's going to create a little bit of angst when it comes to the Federal Reserve. But they also are mindful that the dynamics have definitely changed. August is usually the August print, or the August data set for non-farm payrolls is usually weak. I've been talking about this for the last month and no one's been listening, but it's usually weak. So it's not surprising that we actually saw a weak report. September's report, which will be coming out in October before the Fed meeting, is generally strong. And we see a very strong revision to the upside. You have construction jobs that start to pick up because you have year end. So they're trying to get jobs done before, obviously, the winter season hits. You have back to school. You have the teachers being put back on payroll. So you're going to see government jobs actually increase to the upside on the state level front. That should actually still be a tailwind. And then you have the seasonal job openings for the holiday season starting to take place as well. So that's where you get your curveball. It's not so much, is the labor market weak? Is it weaker? Yes, it is weaker. But your curveball is, what if we do actually see a strong print for the September data set coming out in October? What's the Fed really going to do? And it's not like a crazy notion that could actually happen. This happened this time last year. This playbook is exactly the same of what happened last year. We had this print, people freaked out. We had a very strong September print that we said, what's going on? And then we started seeing inflation coming back up again, and then they started to slow roll. And then people were like, oh, in the November, we saw another cut. And they were like, oh, this is kind of politics. But at the end of the day, the labor market statistics are going to be very volatile around this time. So I think we have to be mindful of that. You're asking me about the dollar. The dollar has definitely pulled back. We were in a strong bull run for the dollar for a very long time. Now you're starting to see it pull back here a little bit. The dollar is, you compare the dollar relative to other currencies, okay? Especially when you're looking at the euro, just in general. Usually when the Fed cuts rates, it's because the economy is getting weaker. That also then leads to a weaker dollar. We probably have seen some of that weakness already being priced into the dollar right now. And I would say, Jason, that technically speaking, if you go back and look at the past, we are almost at the last leg of the dollar flush. Okay. I did put another chart in there, but we probably are at the last leg of that dollar flush. And you're probably looking at a 94, 90, maybe a 94, 93.5, 94 level for the dollar. And that's just going off the technicals. If you look at the weekly chart, we actually do have a bullish cross on the MACD here. We have been consolidating. We're leveraging the 20-week moving average as an area of resistance right now, before we've actually started the succession of rate cut policy from the Fed, probably getting a little bit more aggressive. So I think we're probably at that last leg where we consolidate, probably break down a little bit more. Economic data probably gets a little bit weaker, and then we probably see it kind of basing out here. So I think we're at the last stretch of the dollar weakness, at least for now. So you can see that MACD crossing. Usually if you look at and you guys can do this on your own, look at a weekly chart of the dollar index, put the MACD, put the 20 period moving average on there as well. Usually when you see the bullish MACD crosses, that's not the immediate buy signal for dollar on the longer term time frame. That usually signifies that we are going to have, or that we potentially will see the final flush until we bottom out. And you can see those crosses there kind of align to that same type of scenario. So I think we're getting closer there, but we should expect dollar weakness as the Fed really does cut here. And that's kind of where I'm looking at it. Consolidate for now, probably another flush down once the data really does get bad. And then buyers kind of stepping in.
Yeah, I'm still looking at the dollar long cycle down, but I know you're more shorter term than me, so I want to just highlight, what are you thinking long term? Are you looking at this to flush, possibly bounce again, getting back into a bullish trend, or are you just looking at it getting back into that range between 100 and 112 that we were in for like ever, basically?
No, I'm looking for a very volatile consolidation. And that makes absolutely no sense. But if you go back and you look at the dollar, if you look at the dollar in the times of economic slowing, we still see dollar volatility, but it has well-defined up and downside ranges. And so I'm actually looking for that. I'm actually looking for the halfback retracement, which brings you down to around 95 being your fulcrum there. You have that MACD in a bullish formation, but I still think that we probably battle between 93 and let's say 100 and a half from a technical standpoint. That's where I see, and that's a wide range. But that's usually what we see in these type of events. In 08, we had the same type of, is this an 08 situation? Not yet. But in 08, we had the same type of situation. Back in 2016, same type of situation here. I mean, the administration wants to see a weaker dollar. So they might continue to put policies out there in order to do so. And then you have a credibility question that is out there. So that could be something that does push the dollar a little bit weaker. But I think ultimate support for the dollar right now is sitting at 90. And I'm going to trust the technicals on this one. I think 90. And if anything, I think the U.S. runs hot. And then I think geopolitical risk premium in the dollar also then provides it a backstop for support, which I think is probably a little bit discounted right now.
Yeah, I think, the idea here more than anything is like melt up. Like that's the biggest thing. I think they were kind of sitting on their hands and not wanting to lower rates and so on, is like the market's pretty strong, and it's been strong, whether they've said, hey, we're going to hold rates steady here. Hey, we're possibly raising rates. That was a couple years ago. Then we're lowering rates. Like the market has held up really well. Whether the Fed rate probabilities or whether the Fed's actually said anything about it one way or another. So I think it's definitely kind of crazy right now to think they're going to lower rates, and that's not going to put major pressure to the upside on the market. And that's going to lead us to another scenario where, like you said, I think this is the crux of what you were saying earlier, which is if we get that melt up period, like very quickly, they're going to have to shift policy and say, hey, we can't lower rates anymore. You know, like, and
But
they
do
don't.
they? But do they?
But do
That's
they?
the wild card in this whole thing. This
Mhm.
is, I mean, let's rip the Band-Aid off here, Jason, because I want to kick this back over to you. Let's
Let's
rip the
do it.
Band-Aid off. Let's get down and technical with this. But will they? I mean, at the
That's
end of
a
the
great
day,
question.
we are seeing the political. You're seeing politics being brought into the Fed more than probably what we have ever seen before. Now, given that type of environment, if they do face an inflationary shock to the upside, do you think that they will actually raise rates? I don't actually think
I don't
so.
think so. Yeah.
And I think that's why we run hot. And that's why I said this is early 90s. This is early mid 90s behavior. We run hot. We have sectors that just completely boom, like the housing sector, right? Until something breaks, and it's usually unchecked credit risk.
Mhm.
And I always want to highlight this credit risk is the part of every single downturn or every single economic cycle that creates equity volatility to the downside. And that's where that's where I think we're at. Now, that could be a very bullish market. Equities actually outperform in that type of environment. If you think about it, inflation moving to the upside, let's say that you get this kind of like 2.5%, 3% growth on GDP, and inflation sitting at around 3%. If you're looking at net, that's not really great. But at the end of the day, you're still going to see equity valuations kind of, increase to the upside because of that inflationary risk. And we run it really hot until something, once again, goes unchecked. Lehman Brothers, '08, something went unchecked. Housing crisis, something went unchecked when it came to balance of risk or risk in the system just in general. Look at other even if you're looking at the inflationary boom that we saw late 70s, early 80s, that situation started off with the energy markets, but then once again led into and fed into the credit markets. But if you were cutting interest rates, and this is why you can run this thing hot, I don't want to say this is a good policy, but I'm just saying you have to play the environment that you're in. Credit availability does go up. No matter the environment that you have for the unemployment, for the labor market, if credit availability does actually expand very aggressively, that would be enough for the consumer to over leverage to sustain this pop. And then you still have 0.7% of GDP coming from the AI infrastructure players anyway. It's 10 companies right now is accounting for 25%, close to, give or take, our total GDP, which right now is still in a secular trend. It's not going anywhere. The consumer might be a little bit weak, but the headline GDP numbers are going to still look great. Great. I'm putting quotes up for those that are not listening. And that's where I think you get that environment of just running this thing hot until people are like, oh man, this is not good. And then that's when we see that pullback. I don't think it's the right policy, but I don't think the Fed will actually pull back on this. You are seeing things where people might be intimidated and may not do the right thing because of that political pressure. And I'm not
I
even
think
trying to
that's
get
right.
political. I'm just saying,
No, I
kind
think
of
you're right.
writing on the wall
I
there.
agree with you. My thought is more, I don't think they're gonna, like, people keep coming to me and being like, oh, they're gonna raise rates at some point. I think that's impossible. I think it's possible a pause could happen at some point. Like maybe they start to talk about the rate cutting cycle. But I think, Kevin, you also have a good point, which is that much pressure on that agency that hasn't been seen before. You know, I've tried to go back as far as I could and just kind of look and what happened with the Fed. Was there any
Yeah,
president that ever went
Nixon.
after them like that?
Nixon was the only one that
Did anything? Yep.
yeah. And
Yep.
I think or LBJ, I mean, you can make the case there. I think that got a little physical actually with one of the members, but nothing
Yeah.
that was this public. Nothing that
This
was this public.
public, and at a point where this many people are paying this much of attention to the Fed. Like that's the other thing a lot of people don't know is if you go back to like the traders in the 70s, 80s, you know, they didn't pay any attention to the Fed. People talking about liquidity and, you know, the idea of lowering rates and what it's going to do to stocks, like that wasn't a thing for a long time. Yes, you had valuations. Yes, you had higher yields and the understanding of what that was. But for the most part, what the Fed was going to do, that wasn't something that really started where we had Fed watchers until the 90s. Now we have every single trader knows what the Fed's doing. They watch Powell basically speak in Fed speak and not say anything real. You know, you're basically kind of watching this over and over again, and people pay so much attention to it. So I think that's why this one's so significant. And it could mean we either get into a situation where they're intimidated and they just keep lowering rates because they're told to lower rates, and that's the end of it. Or you start to see like Powell go, hey, you know what? I'm an old man. I've got all the money I could need. I'm out. You know, like, and he'll just move
well, he's
on.
going to be out in March.
Yep.
Anyway, so yeah, look, I mean, if you're Powell right now, do you see the political pressure? Do you bow? I mean, there is a reason to cut 25 basis points. Like, let's not get us fooled here. You have to kind of chomp at the risk of labor market completely falling off a cliff, because that's something that takes 12 to 16 months to be able to correct itself, right? Like, the snowball for labor gets really difficult. But for Powell, people talk about his legacy. Right now, if he kind of says, you know what, we could do 25 basis points, you do 50 basis points, let's say we get 75 by the end of the year, he knows exactly what we're talking about. By the time he gets out is probably when we'll start seeing the first effects of the rate cuts, because it takes a long time to actually be reflected. He knows. Then you're not going to be able to blame him. He cut. Now he cuts, and then inflation rips to the upside. That's for the next person. That's for the Kevin Hassett's or whoever gets that. And that'll be interesting to see how that measures up. And that's where then you also look at the yield space on the long end. Does it start to move up even higher because of that potential policy error? Or maybe it's not a policy error. Hey, dude, I did see some people throw us some questions. I don't know.
Yeah. Let's get into them. So we got the first one up here. So this is one that's asking about the ratio, you know, looking at the ratio of XME SPY. I think I actually did bring a chart of that. Let me see if I have XME. Yep, there we go. So let me bring this back up here. So asking the question, hi, Jason, how will you know when the uptrend in commodities is ending? Do you look at ratio charts, XME SPY? Ratio looks like we're just getting started. So, you know, answering this one very quickly, just from my opinion. One is I'm a trend follower, like, and it's a way I've figured out a way to make money that fits me and my personality. It doesn't mean every single person has to trade the exact same way, but when something's moving to the upside, it's making new highs, I'm not going to ask myself that question. And I'll give you a quick lesson in trading. When you're a new trader or you are an unconfident trader, you start to think of things like you get very pessimistic when trades are working the right way for you. For example, you see this thing moving up and basically, you know, let's say you got in around here. Let's say it was a false breakdown signal. You bought this breakout back to the high and you just start riding that trend. And as it's moving up, you're getting more pessimistic. And a trader who's like a trend following trader who's good at trend following, they're going to get more optimistic. And it just goes back to old trading lessons, you know, Paul Tudor Jones, losers average losers, meaning when you're in a downtrend like this, you're getting more optimistic and you're going, I need to buy more. It'll raise my cost basis and so on. And then if you're a good trader, you usually add to positions as they're in uptrends. So if this thing's moving up, and the reason why is go back to Reminiscence of a Stock Operator. It's a book by covers Jesse Livermore. It's not by him, but covers Jesse Livermore. Great book. You guys should all read it. But basically it talks about letting the market confirm what you're thinking. So, you know, there's plenty of times I have tons of opinions, and Kevin does too. And we could all sit here and figure out like what the market's doing. But why do we look at the charts so deeply? Like, why are we always looking at technicals? Why are we talking about, Kevin's always talking about MACDs. I'm always talking about breakouts. Why are we always talking about those things? Because the market is confirming what we're thinking. We're not just going to enter something. Like I might have an idea that oil should move by the end of this year. It doesn't mean I'm just going to buy it. I'm going to wait for the right signals to do so. So I think here, like if you're looking at metals and mining, if you're looking at the gold miners, whatever it is, they're in uptrends until those trends break. And you have to figure out how you do that for yourself. Do you use a crossover strategy? Do you use a MACD? Do you use amount of day lows or amount of day highs, whatever it is? Figure out how you understand when a trend has broken and then just get out of the position. For me, I'm not seeing any reason to think any of these trends have broken down or anything just yet. The only thing that's concerning is energy hasn't really caught up, but that's usual. That makes sense. So, do you have anything else to add to that, Kevin?
No, I mean, metal and mining sector, I personally, I'm not a fan of mining companies, but you know my thoughts when it
Mhm.
comes to commodities. Like, try to trade it directly as much as you possibly can, so you can reduce the risk of leadership errors, executive leadership, problems with a specific company and things of that nature. I think right now, if you play these before earnings, I think they've served as really decent proxies. That would get a little bit concerned after, leading up to the earnings announcement for, say, like a Freeport McMoran, right? Like, they had
Yep.
a decent earnings announcement when it came to some of their guidance and their commentary around copper. Now, obviously, the stock did drop, but like, if you look at the commentary around copper, they were super bold up because they were like, "Hey, this is when copper is touching was it $5 or something?"
Yeah.
When copper was hitting, I'm sorry, $6 and around $6. Let's say $6. And they had some very strong commentary. And this was like the week before you actually saw that Valor candle, the biggest move in copper. And they were like, look, if we can have copper at these prices, they were going to print money hand over fist. Free cash flow is going to be through the roof. And then we saw that drop in copper. And so, once again, this is one of those situations where you trade it between earnings. You have this whole enthusiasm when it comes to commodities. Boom, they continue to move higher. Cool. But wait till you get, the earnings announcement, then you might want to like be very cautious when it comes to the mining sector because they make money over the long term. Commodity prices can move higher, they can move lower very quickly, and these are going to be companies that have an impact here. So I'm not look. That's been a phenomenal trade. It's just everybody has like their style. And for me, mining companies are just not my style. Like, if I'm going to trade gold, or I'm going to trade silver, or I'm going to trade whatever, copper. But the miners have been, the chart looks great. Don't get me wrong. That's, I mean, like, there's breaking out. Like, it's doing a phenomenal job. It's just not my cup of tea to play those names.
Yeah, I think it's the reason why I trade the ETFs in that sector is exactly what Kevin has just brought up. Like, a lot of people like to get into the individual names, and if you're good at that, great, phenomenal. Very happy for you. I don't feel like I have a huge edge in that. So I usually play the ETFs. Just to, not to say one's better than the other. I like the futures, obviously. I completely agree with Kevin, but I also trade the ETFs because the earning risk isn't as, it's there, but it's not as extreme. You're not going to get hit for like 50% on an earnings day. So I'd rather be, and if you do buy the individual names, buy more than one. Buy five. Make your own ETF out of it. Not to mention the international miners are looking better than the U.S. miners at the moment, like things like BVN. So I would say continue to look into those areas for places that you can make a lot of money right now, and then also build a diversified basket. So we got a bunch of
And what usually happens, I think somebody else brought this up. I'm going to paraphrase this, but like, gold and some of these doesn't trade usually at these premiums compared to, let's just say, their all-in cost, right? And that's where this is where the mining question comes into play here, because usually the miners, once again, will get positive retail flows when you have prices moving higher for gold or silver. But when you're looking at the fundamentals, as the prices kind of move up, the miners start to nibble and say, hey, okay, CapEx spend, let's ramp this up. We need to get more supply in the market because prices are higher. And usually those miners are late with that CapEx spend, and prices kind of revert. And then that's where you get these bearish cycles when it comes to the miners as well. So once again, really good trading vehicles. You talked about the diversification. I'm right there with you. Do the miners actually put dollars to work, or do they constrain supply? Now, if they constrain supply and they're not trying to build out CapEx, that's a tailwind because you get higher prices, and then you can sustain that difference, or the differential between premiums. Because I agree with them, but once again, kind of just depends on how these miners really want to, how they really want to move. Right now, you're seeing a lot of the miners also kind of expanding copper mining operations and putting dollars to work and starting to announce a lot of these. I've seen a bunch of announcements over the last 2 months or so. And that's because copper has been rising to the upside. We know that there is a structural shortage for copper compared to the physical demand over the next 10, 20 years or so. We have seen prices moving higher. once again, a lot of that price was tariff risk. Are you going to be tariffing refined copper and things of that nature? And now you saw that price kind of flush while you're having these announcements. And now those companies are going to be like, hey, I hope that it can at least sustain here. We don't go back to the threes, because then we got a problem, because we're spending money on increasing supply when the market also then gets a little bit weak. And that's from a fundamental standpoint. That's when you're looking at executive leadership. Can they execute? Do they know what they're doing? Because they should be expanding mining operations and supply when prices are low, because you have lower break-even points for those operations, and then you constrain supply when prices are high, so you can actually make margin, a premium margin on those products. Some mining companies do the exact opposite. So
yeah, I mean, it's here's the thing with all of the mining companies, whether you're in gold miners or not. Some of these companies are okay, but like, let's be honest, the broad spectrum, that's the reason why, like, I'm not a person who's like always own the miners. Like, I will never hold a miner like for life. Like, there's a royalty company in my long-term portfolio. That's probably the only one I've had long-term. But most of these companies are crap. Like, let's be honest. Like, it's a hard industry. It loses a lot of money. But right now, with low oil prices, high commodity prices, if we're looking at gold, silver, copper's even decent for their bottom line at the moment, it's okay. Like, it's okay at the moment. But you're going to also run into this thing later in the cycle, which is, I think, upcoming for gold. I don't know when it will happen for copper, but we're looking at this, like, probably starting to get into the real junky areas, starting to go crazy, like the explorers. Like, that's basically somebody standing next to a hole in the ground. It's the best way to explain it. Like, you're hoping to strike gold. You're talking about it. You say you found these deposits or whatever. You tell all the investors, you go public and so on. And then a bunch of people get excited and buy it. And either you find something or you don't. So the stock either goes crazy or it just goes to zero. So that's probably the stage that we're in right now in gold and silver. So I think it's a good time to get in the explorer stocks, but know that there's a lot of risk there. So if, like, you're trading it, like, really follow somebody. Like, Kashop's very good at finding those out. He's really good at analyzing those, but he would also tell you, like, I'm not just going to buy one of these. Like, because buying one, you could lose everything on just one trade. So you want to buy it, diversify. Think of it more like if you're doing venture capital. You're doing venture capital, you're not just going to invest in one company. It might take you 10, 15 companies to have one company make a bunch of money. So you want to kind of diversify, I'd say, 5 to 10 different miners, depending on the size of your portfolio, if you're in those explorer stocks. So let's hop to the next one. Speaking about gold. Gold can hit 4,000 this year. Silver 50. Questions. So I'll pass this one to Kevin. So what are you thinking here?
A lot of large numbers. Can gold hit 4,000? Yes. I don't think there's a question there. Just given the trajectory that we have seen, you're talking about gold going up another 10% from current levels to get 4,000. So is it possible based on a technical breakout? And what you could actually do is, if you look at the high and low of that consolidation, and I'm taking top tick high to bottom low, that was a 11.8% move, high low top tick. That's the consolidation between April and let's say August, right? And this is just a technical thing. You take that range and then you add it to the breakout, right? And so if you add that to the breakout, you look at another 12% to the upside, because that's the 12% range added to the breakout high. You look at that and you get to $3,953. What's $20? So that's $50, $47 amongst friends here, if you're talking about the extension. So that's just a technical extension range. I'm not saying, like, that's not a recommendation, like, oh, it will hit 4,000. But if you're just looking at the technical breakout, it's within the range, or fairly close to the range for 4,000 for gold. Silver, silver's on a tear right now, and it's trying. $50 is going to be a little bit challenging, though. I won't say it's challenging. The amount of time it takes to get us to $50 is what's going to be interesting. Let's say that. Is it a steady grind higher to 50? Probably get a little bit more confidence that, hey, some buyers are really trying to step in. Or do you get a sharp spike over the next 2 weeks, 3 weeks, or a month to $50? that's where you get a little bit concerned that we have a blow off top scenario taking place. So the trajectory to get to $50, is it there potentially? Time frame by the end of this year? I mean, that definitely can happen. I mean, you're talking about another $50. You're talking about another 17-18% move to the upside for silver. That's not that much. I know it sounds crazy, but it's really not that much when you're looking at the volatility of silver. Now, when we get to $50, that is where it's going to be very fun, potentially. Because if you look at the longer term chart for silver, you're talking about the highs that we saw back in 2011. And then do we actually have a breakout, like a monthly breakout above 50? And that's where it would get very, very fun. So $50 by the end of this year, is it possible? I would say technically it is. You still need to have, when we talk about this, you still need to have all of those things as fundamental catalysts in place. As soon as one of those shifts, it becomes harder. And so if inflation starts to actually show disinflation trends again, right, where inflation is moving higher, but it's decelerating, that's not really a good environment for silver. What if we see deflation for the inflationary print, meaning we start seeing negatives because the labor market falls off a cliff over the next 2 months, 3 months? That's not really conducive for silver. What if we start seeing weaker economic data coming globally? And you could say maybe that's happening in some respects. Canada also had like a massive re-rating when it came to their unemployment rate. But I think if you're looking at the global stage, you're looking at the Asia markets, you're looking at Japan, you're looking at China, and you're looking at Germany. The UK is going to be a little bit of a problem, but Germany is really kind of the powerhouse for the EU. You still need all of those things in place, I think, in order for silver to continue to have the bull run. Anything that changes is where it gets a little bit dicey. But could it? I mean, you got 3 more months. At this rate of change that you are seeing, could it be possible at this rate of change on the weekly? Yes. $50 could be possible.
I think 50's to me it's a chip shot from here. And the reason is that we're getting over those closes. To me it was the weekly, monthly closes that were hard to get over for silver. Around $38, $41. Quarterly close I think was around 38. So all of these long-term closes, we just had a lot of trouble getting over. From here, I think it can hit it pretty quickly, especially in the environment we're in. Now, once again, like the reason why, I speak the way I do is because I'm riding the trend. I really do think, and I speak to the trend, and usually the fundamentals for me are based on what's going on with the actual price action and putting that together. And looking at it that way, I think, it's a chip shot away. Kevin, on the other hand, is very tactical, much more tactical than I am. So, listen to Kevin on those tactical levels that you guys can look at, continue to kind of pay attention to. And I'll kind of talk about more to the primary trend. And just a way to kind of understand like how we both do it. Not that Kevin can't figure out, the primary trend on his own. Not that I can't figure out the levels on my own. It's the fact that that's what we're speaking to most of the time, just for you guys to get an understanding. I did get a question here about, do you guys watch the bond market, specifically Japan, UK, France, and the US? Just made a video about this yesterday. If you go to the lives, you can basically see the chart. I think it's the chart of literally the US, UK, not France. It's Germany, and maybe Japan, another one too. But check that out. It's just the last video on the lives. But yeah, I mean, this is one of the most important things to continue to pay attention to is the bond market. It's one of the biggest. It is the biggest market in the world. It's where liquidity comes from. It's how you can tell what type of environment the market's in, and also understanding the spread between the short-term yields and the long-term yields. But definitely check out that video. We go really in depth on this subject because it's something that I've been following for a long time, paying a lot of attention to, and I keep updating everybody on, which I do think the 30-year yield's probably headed higher. I think it'll follow. Japan was ripping. This is interesting, Kevin, and we could talk about this a little bit. Japan was ripping for so long, and everybody, I remember writing about it. I think when it hit like a new all-time high, I remember writing about it and so many people being like, well, it's Japan, who cares? Like Japan's some like small country that nobody cares about, and I was like, man, that's crazy, but it's totally like a normal US thought. And now we're seeing that show up in if you look at the UK bond yield, that's at its highest high since I think 98. Most of the rest of these European countries are kind of consolidating and ready to break out higher if they're not already breaking out higher. The US, if you were looking at that chart of the US bond yield and it was Nvidia, everybody in the world would say, oh, that's about to break out. That's a great flag or whatever they'd want to call it. So, question for you, what are you looking at here in bond yields, globally? Speak to a specific country, whatever you're thinking.
Yeah. So Japan, we could kind of kick it out. Now, this one's actually going to be interesting because I think the Prime Minister of Japan just resigned like yesterday night, if I'm not mistaken. So we'll see what happens with yields on the 30-year. They have been moving higher. When you kind of look at these developed countries, though, yields will get up to a certain point where buyers will step in. That's just how the function works, right? It's either you have to have an attractive yield that's high enough where buyers really step in. And I think we're probably at that point on the global stage where the market's trying to figure out where is that top tick range for Japan. They have their own in-house issues when you're kind of looking at that economy. Obviously, leadership has been, let's say, wishy-washy is probably not the best word, but it has been wishy-washy when it comes to the direction of monetary policy as well as fiscal policy. Japan's actually it's something that we have to be mindful of and keep our eye. They're huge purchasers of U.S. treasuries. So if they have a weak currency or something gets completely blown out and they need to raise capital, how are they going to raise capital? Most likely probably selling treasuries. This could be one of these countries. We talked about it earlier, T-bill auctions looking a little bit. This is probably one of those countries that might be pulling back just a tad bit. When it comes to those purchases, because they might need to actually deploy some of that capital elsewhere in order to stabilize their markets just in general. So that is a risk. UK, I think, is something a little bit more systemic. Like they have a budget issue and they're split politically. So they need to raise money. And now the big battle is, how do you do that? Do you raise money on social services? Do you raise money on corporations, or do you cut back social service programs? And it's been a battle that we've seen. In 2022, we had the same situation, the Liz Truss moment. And I think she had kind of a Scaramucci type of moment when it came to her tenure. I think it only lasted for like 15 days. Where you rolled out a budget that was something that the markets did not like. You saw bond vigilantes selling off their treasuries on the long end. Yields spiked higher, and we had this kind of a little bit of a credit event that luckily did not permeate across the globe for any sustainable amount of time. But I think they have something kind of in-house here. And then the U.S., if you're looking at the 30-year treasury pretty much hitting 5%, yeah, that might be a little bit of a problem. But these always happen in cycles. We see this. We talked about this earlier this year, Jason, when it came to the Canadian dollar. I mean, you see these type of situations, you see these cycles. And I think you probably will get to a point where yields will be high enough where it makes it look a little bit attractive for investors, maybe especially institutional investors. And that's kind of how I'm looking at it. So is it a concern? Is it signaling something? Yes. Is gold signaling something? Yes, it is. But we have not seen a breakdown in credit markets and liquidity markets to the point where we can pinpoint what is the actual problem. They all have their own one-offs, but we haven't seen it come into a singular portion where it impacts everybody yet. And so I think you have to kind of manage those. You're talking about a longer-term portfolio. I mean, 30-year bonds, longer end of the curve, kind of may start looking attractive for some people, not everybody, but for some people, because now you're seeing the re-rating of short duration, and even the middle of the curve, 7 years, 5 years, 7 years, and even 10 starting to catch a pretty decent bid over the last month or so. So kind of where do you go to find yields probably at the longer end of the curve? I just don't know what that level is. It just kind of depends on you. But it's signaling something. And it's a normalization of a curve too. I mean, we were in the market was not normal, sitting at 0% interest rates either. Yeah. So we're kind of like we're getting a pretty decent refresh here, and I actually like it. I like seeing this kind of getting washed out and seeing, okay, what are you willing to pay for a 30-year treasury? What are you willing to pay for uncertainty?
Mm-hmm. Yeah.
And time risk.
Yeah. For me, I'm staying away. But I also do think like you got a great point, which is these big, retirement firms, like they're going to be looking at that and starting to think that this is pretty attractive, so there could be a situation where, especially if you're looking at it long term, like let's say you're a 20-year-old kid and you're like, man, I want to put my money in bonds for the next 40 years or something, like go for it.
Yeah.
For me, it's a little bit different, but everybody teach their own. So looking at this one, love copper. How are you feeling about copper? We covered copper. We talked about it. So if you want to go back a little bit on the show, basically, I think that was the third thing we talked about today. You could check that out. But yeah, we've been talking about copper. We're feeling good about copper. Well, I'm feeling good about copper. I don't want to speak for Kevin. But I'm feeling good about the miners, especially at the moment. I like the way that they're still holding up pretty well, even though the price action isn't doing great. This could be short-lived. But once again, I'm still long these. They're in uptrends. Kevin, you could add
just real quick. Yeah, I think it's in the cycle. But that's just me. If you kind of look at it from a technical standpoint, I mean, copper is usually the only one that I see on a commodity front. It's not a recommendation either. It's just, if you go back and look at trends, copper usually has triple tops before we break down. Now, what's interesting is that you can still make the case on the 3-year weekly that it's still making higher lows. So that's technically not a breakdown yet. And then you're looking at trying to hold that 200 week moving average is sitting at $4.17. I just am of the mind that either this thing is about to consolidate and rip face, which is a very technical term, or we actually have a breakdown. I'm just going on past trends and that say, hey, we have a push. I mean, you look back in 2021, 484 was like the big level, right? Come back, retest, came back, tried to retest higher, and then we had this massive breakdown going on in the 400, the 200-day moving or 200-week moving average here. I mean, we're actually not that close or not that far away from that 200-day moving average. So like the flush has already happened, if you will. So you're talking about another 40 cents to the downside, give or take, until you actually hit a critical area of support. Go back in time. If we're going to fail that 200-week moving average, that means the economy is also going to be slowing down. I mean, it's a pretty decent indicator, just like crude oil. Crude oil breaks below the 200-week moving average, breaks below $65, usually signifies that the economy is slowing, at least on the demand front. Mm-hmm. And so that's exactly what crude's doing as well. So I'm of the mind, I mean, the technical trend is still higher. I'm of the mind, though, that we might be breaking down here. It's a tough trade, though. Be careful with copper. Be careful with it. You got to be careful with it because
it's also if you're in copper futures, that's also another thing to talk about. If you're in copper futures, it is a very illiquid contract. It's liquid enough to trade. Not saying you can't trade it. I trade it. But at the same time, it's a pretty illiquid contract, which is why you see these huge 10% moves and down 20% and so on. Spot copper globally looks a lot better. Even if you look at the LME futures and so on, which is part of the reason why I've kind of held my copper. If it doesn't break below 425 on the US contract, I'm not bearish on it just yet.
You bring a good point up, dude. Let me just kind of highlight. You bring a really good point up.
There's a wavy brought up. Look at this, Kevin. Let me kick this girl out of bed. It's time for money.
Hey, if you look at that is actually, that is another bull case that you still get squeezes in the LME market? Because London Metals Exchange has had some issues with a lot of the metals as of late. And so there's this differential that you have where you have a premium being paid on the LME and then there's trading at a discount on CME, if you will, right? So you get this kind of like, you get this barbell approach. What's also interesting about the LME, and a lot of people don't really actually know this, they have daily expiration contracts on these metals, especially for copper. So like, you'll have a day where somebody, for whatever reason, just like squeezes the hell out of the daily contract.
Yeah.
And then people freak out and then they're looking for their hedge. And the hedge is usually CME, which is where you get these aggressive pushes to the upside, or even failures as well. And so you kind of have these, like, I don't even want to say gamma squeeze moments, but it is kind of a squeeze moment because of these daily products that they actually have rolling out. I want to say, like, sometimes they become a little bit unsustainable, but they do create a pretty aggressive pricing pressure. So good call out on that one, because the LME is a wild card for a lot of the metals, especially for copper. Once again, I just look at the technical trends and I go back the last 20 years. I haven't seen, I mean, it seems like we try to have that little triple top here. We might be consolidating and basing out. So
yeah, I think you know, when we look at the LME, also something to just talk about what happened to me in 2020. I was long nickel, lead, something else. And they just basically closed all my positions and gave me my cost bases back, even though the positions were up massively. So, like, I'm just not a big fan of the LME at all. So trading it wise, not something I do. But looking at it for some of these indicators makes sense. But yeah, so natural gas, did natural gas get covered? We did not talk natural gas today. That's something that Kevin and I usually talk about every single time. So, you know, we'll end up.
Can we talk about this one though? Because I believe
please.
This is Skynet. I believe this individual, I don't know if it's, actually DMs me. Actually does. So I want to make sure we answer that, because really good supporter of our content, it looks like.
Nice.
All right, so like I'll kick it over. I'm going to kick it over to you after I kind of just like have this brief rant. Go back in that playlist for this commodity report. We were doing these a lot more last year. This time last year, we were doing these once a week easily, right? Even sometimes twice a week. Go back, look around this time last year and listen to that commentary. And the reason why I bring it up is because I'm going to say the same thing that we have going on for this year. Usually September, first 2 weeks of September, and you're already actually starting to see the bids, we start to get prepared from a pricing standpoint, getting prepared for the ending of injection season. So injection season is taking natural gas, putting it into reserves, and that usually lasts up until about the middle to last week of October. And so markets try to front run that as much as they possibly can, right? And we start to get prepared for the winter months or the draw seasons for natty, which generally is actually bullish for natural gas prices, because you have the seasonal, you have the winter, premiums, you have the weather risk premiums that are taking place here. Natural gas structurally is still a very tough trade because we have so much of it. So supply kind of outstrips for a while. And so prices kind of get depressed. And so if you're looking at fundamentally, prices generally will continue to go down. But I think over the next 2 weeks, next 2 months to 3 months, you got to be prepared for that risk premium moving higher for natty, because obviously it's something that gets aggressively shorted. And you have to figure out how you want to really kind of play it, because it's very difficult. Do you do the natural gas futures contracts? They have micros, and the micros for the most part are actually fairly liquid. The large contracts, I'm going to be honest with you, I mean, unless you have dollars, I would not max out the account on trading a nat gas futures contract. It gets very, very dangerous to do so. You also have UNG, which is probably the best proxy that you have on the equity front, just because of the liquidity that is there. The structure itself is difficult. You do pay a little bit of a premium, especially when you're looking at the options on UNG, but there's also another proxy that a lot of institutional traders that don't like to trade into the futures contracts will leverage UNG as a product offering here. So not a recommendation. It's just, if you look at a seasonal chart, usually this time of the year, we start to actually see prices kind of moving a little bit higher. The only other thing is the LNG demand is starting to soften a bit in certain markets, especially the Asia markets. And so if LNG starts to kind of soften when it comes to supply, that means that more gaseous form kind of hits the market, supply hits the market, that pushes prices to the downside here. But the weather premium, I think that trade is something that we do see prevalent around this time of the year. And I would not be surprised if we see that happen this time around as well over the next month and a half. 2 months. Chart wise, it looked like it does want to break down, but
yeah,
seasonally, I think it's one of those ones that, and the weekly is kind of it's trying to base out here. It's trying to base out. We'll see if it's going to actually do it this time. What do you think, though?
Yeah, if you look at it, just from a technical standpoint, there is a false breakdown signal that's kind of incoming. But at the same time, it's like it's natural gas. It's a tough one to trade on anything that's rational. So false breakdown signals are usually pretty good, but once again, it's this market does whatever it wants to do. I always call it the exorcist because it's like spinning its head around, going to go whichever direction. I always laugh when it's in the portfolio because I'll look at, like, let's say you just have this crash day, let's say Liberation Day comes and happens and the markets are crashing, everything's down. For some reason, natural gas is usually green on those days and up big. It just does whatever it wants to do. So, be careful trading it, obviously. Small positions. That's what I always say about natural gas. I love trading it. It's just a vehicle like anything else. It's extremely uncorrelated, which is awesome. But just have small positions when you're trading it because it makes big moves day after day. It's one of the most volatile commodities you'll ever see.
And you want oil prices to move lower for natural gas prices to move higher. There's a direct relationship with shale production, just oil production here in the United States, because natural gas is a byproduct of that. So you want to see rig counts continuing to move to the downside. You want to actually see demand for oil kind of like fall off a cliff in order for natural gas prices to move up. I know that this individual also reached out and asking questions about LNG companies and things of that nature. LNG prices trade more and more correlated with oil prices rather than natural gas prices. So if we have lower oil prices, you have lower oil demand, you have obviously rig counts going lower, we have production going lower that also constrains the supply of natural gas itself, which then raises prices of natural gas, raises prices of LNG. So there's also that correlation you have to be mindful of as well.
Yeah, so we'll end on this one. It's a good one for Kevin.
Yep.
Do you guys follow the Ukraine war? Are there risks to the oil market that aren't priced in?
Risks to the oil market, I would say not so much. I mean, a lot of that risk premium's already kind of been like backed out. Those oil supplies for Russia have been kind of rerouted, if you will. So they have sustained buyers now, India, China. I mean, we hear about it all the time, every day. I still think there's a risk premium that's not being priced into commodity markets just in general on that conflict actually escalating and spilling over to other countries, say like a Poland, if you will. One of the under the radar items that heard the last week and no one's like talked about is like all of this talk about how we're kind of backing away from the Ukraine conflict, but we're gonna like literally double down on Poland and put strategic assets. We already have assets there, but like beefing it up significantly, and we are going to back them is a big deal because Poland's right next to Belarus, and we are seeing a buildup in forces in Belarus. So, is the risk of this conflict escalating even further? I think so. I really do think so. Could that push oil prices higher? It probably could. But if you're looking at it from a supply side standpoint, I don't think it disrupts supply markets. But I think you probably get a premium boost just because of the event itself. Like everybody's freaking out and it's like, okay, we got to buy oil for whatever reason, even though all of the oil infrastructure for the most part has already been kind of disrupted. The supplies have been kind of disrupted. I think also the underpriced risk right now is Asia conflict. So I think geopolitical risk premiums just across the board is really cheap compared to like what's actually happening here. But you can never time geopolitical risk. It just, when it happens, it happens. I think you actually have more of the expansion of this war throughout Europe, I think is a bigger risk. And I think that's actually more of a tailwind for natural gas more than anything. That is the one that you can see a massive re-rating, just like we saw with the opening of this conflict rather than maybe oil.
No, I agree. So let's end it there. Looks like everybody's questions got answered. Oh, any comments on potash?
Potash. Prices are gonna go a lot higher right now. Fertilizer prices are already going higher. It just depends on how you trade it, and then also depends on the U.S. Canada trade deal if there is one. that should actually push grain prices higher, but unfortunately, we do have a glut in supply. Be also keep your eye out on soybeans as well as corn. They've been completely getting decimated, but the recent, and I haven't looked at the recent WASD report, if I'm not mistaken, saw actually a pretty decent drop in ending inventory stocks for soybeans, and we actually did see a decent price being bumped up there. So that could also be a thing with potash. It does appear like those chemicals are moving higher. Now, the chemical companies in general, when you're looking at equities, are not getting any bids off of this, and I have no clue why. But yes, we probably are. You're seeing prices kind of going higher here, and that's going to have an input price increase when it comes to agricultural goods. That will also then raise prices for feedstock. Boom, 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 kind of down the road. So yeah, you're already seeing it. And this is actually, it's really not even, it's not even because of like a supply issue. It is literally tariffs and then this spat back and forth between rail cargo between Canada and the United States, which actually has a big deal when it comes to fertilizer prices in general as well. That's one thing that you can look at Canada having the upper hand on us here in the United States. So.
No, I love it. So let's end it there.
All right, watch some football
with us. Yeah, we've been on for a while this morning. We covered a bunch of stuff. Please follow Kevin KG Bull and Bear on Twitter. Definitely, check out anything. We'll try to get on as much as we can going forward. I'd love to get Kevin on again in the next week or two and just kind of get an understanding of where we're at. Thank you guys for joining us. No, we're not on every Wavy Ass every Sunday. We're not on every Sunday, but, it might be a time where we do some pop-up lives from time to time. We're both just chilling on a Sunday morning. One might hit up the other and be like, hey, you want to go live? I got something to talk about. So we might see you then. So, all right, guys. Thanks, Kevin, again for joining me. And we'll see you guys next week. I'll see you on Thursday for Gold Rush Live. That's at 2 p.m. Eastern time. And then Friday for the Holy Macro Show. That's at 10 a.m. Eastern time. See you guys then.